Dear students, today I completed the evaluation of all the 38 papers for the students who appeared for the midterm examination. And I found that there are many topics on which there are a lot of students who had difficulty in understanding, and also they had answered things which were not correct. So I, so I thought of actually sharing my thoughts on the topics where I found a large number of students had confusion. And it feels bad that uh, I do not get many questions in the class, but the questions which are discussed, those were not also understood fairly well. So I thought of, instead of wasting time in the class, why not make a video and share with you, telling what the concept means. So let's see what are the topics that will be covered. I saw quite a large number of students having issues in understanding the market capitalization, then in the fundraising for the companies, where students mentioned that a company can raise funds through government securities. There was a lot of confusion on long and short trades, even though we had discussed it in detail in the class. Creative accounting is another area where people had got very limited understanding. Cover order also is one of the areas that people did not understand fairly well. Some students wrote, quite a few, that risk reward ratio is a ratio which is used for valuation of the company. Then on the three bullish candlestick patterns that are asked in question number four, many students wrote doji and hammer as bullish patterns. So I thought to explain all these concepts. So what is market capitalization? It's nothing but the current valuation of the company. How do you find out? You multiply the share price of the company with the number of shares issued. It's as simple as that, nothing else. It is not related to the share price. A share price could be 10 rupees or 10,000 rupees. It has nothing to do with the market capitalization. It's only the share price multiplied by the number of shares the company has issued, that is the market capitalization. It has nothing to do with the available capital of the company. It has nothing to do with the growth potential. It has nothing to do with high risk or low risk. It's only a number which is derived by multiplying the share price with the number of shares issued. Now let's see if you can find out uh, how it is done. Just look at one of the companies, which is Bharat Electronics, with the market capitalization 1,80,000 crores. The current price is 246. So if you divide 1 crore 40,000, 1,80,000 crores divided by 246, you will find the number of shares the company has issued. Because number of shares issued by the company into the current price says the market capitalization. Now, suppose you go for any company. Uh, Let me take Suzlon Energy. This market cap is 67,000 crores. So 67,298 crores divided by 49.7 gives a number which tells that how many shares the company has issued. As simple as that. But many students have written that, uh, the share price or the available capital. No, it's not. Market capitalization is only the product or the multiplication of share price and the number of shares issued. Second is fundraising by the company. One of the questions is that what are the options a company has to raise funds? There, some of the students have written that a company can raise fund through government securities, which means that they do not understand what is government securities. They do not understand the options available to a company. Government securities are instruments which are sold by the government to raise funds for the government itself, not for anybody else. So, how can a company raise funds by government securities? I mean, it's counterintuitive. The government securities are sold by the government to raise funds for the government. It has nothing to do with the company. A company can issue funds or raise funds by issuing bonds, debentures, or it may sell shares either through initial public offer, which is primary, or by secondary transaction, meaning the stocks which are held by the company, they are sold in the secondary market to others, be it FII, DI, public, whatever, or it can take loan from the banks. So government securities has nothing to do with a company raising funds. Long and short trade, especially I remember I might have spent two, three different classes where this was discussed. But still, a lot of students had got issues here. It's about the direction of the trade and the opening trade. Opening trade meaning, what do you do to first take a trade? In a long trade, you first buy, then sell. Many students have written that first buy, then make profit and sell. Please understand there is no guarantee of a profit or loss. The direction of the trader is that he expects, he anticipates, he has calculated that the price will go up. That does not mean that after he takes a long trade, the price will definitely go up. So it may lead to profit or loss. If the price goes down, then the person who has taken a long trade, he makes losses. There's no guarantee of profit. Only there is a conviction of a future trend. All positional trades in stocks are long trades. Or a long trade is possible in all kind of securities. It can be stocks, it can be futures, it can be options, in all kind of things. It can be done in commodities, currencies, uh, or bonds. Everywhere long trade is possible. It has nothing to do with the holding duration. A lot of students have written that in long trade, people hold it for 1 year or 5 years, 10 years. No, one can hold it for 1 second, 1 minute, 2 years, 5 years, 10 years, 20 years. It has nothing to do with the duration of holding. It's only the direction. Means you are buying first. That is a long trade. Now, short trade. Short trade again, the first you sell, then you buy. That means you are selling at a higher price, then buying at a low price, expecting to make profit. But again, as in case of long trade, there's no guarantee that if you sell at a higher price, that the prices will definitely fall. What happens if the price goes up? You make losses. It may lead to profit or loss. No guarantee. Short trades in stocks is possible only for intraday, but short trade on positional basis is possible for all derivative instruments like future and options. So one can sell a future. Assume that you're talking of a Reliance future or State Bank of India future or any F&O stocks future. You can sell it and hold it for a long time till the contract expires. So derivatives of indices, stocks, currencies, commodities can be done in a short basis. You can short a future or a option. Duration of holding of the derivative in short trade can be for few seconds to few months. Suppose you sold a Nifty future now, the next second you can actually buy it back and close the trade. Or you can hold it till that future contract expires. So here in the case of short trade also, the duration of holding has nothing to do with the type of trade. So please understand, long and short has nothing to do with the direction of profit or loss. It is to only what is the first opening trade, whether it's buy or opening trade is a sell. That determines what is a long or short. Creative accounting is another one. Many students wrote that creative accounting is done to make the stock more attractive, to get more money, to make the company better. No, it's related to manipulation of the financial statement. There are many financial statements. So some of them are like balance sheets, profit and loss account, cash flow statements, income statements. So in a simple term, these statements are cooked, manipulated to make it look better. A company doing creative accounting indicates its malafide intention and poor quality of management. It is done to hide some unpleasant truth of the financial performance of business. The company might not have done as well as they expected, so they try to modify the data, manipulate the data to so that it is done better. It has nothing to do with more profit or less profit or loss. It has nothing to do with company valuation or share price. Please pay attention when it is being discussed in the class, or you don't understand, please ask questions. But answering them in a wrong way does not help you anyways. Some students wrote that risk reward ratio is one of the ratios for the valuation of the company. For heaven's sake, it has nothing to do with the valuation. It's a ratio a trader or investor calculates to determine if a trade should be taken or not. If your risk reward ratio is 1 is to 1, 1 is to 2, 1 is to 3, 4, 5, 6, then a trader decides or an investor decides if my risk reward ratio is 1 is to 5, meaning if I'm losing 100 rupees, then this trade might give me 500 rupees. Then the risk reward ratio is 1 is to 5. Then only I'll take a trade. So what happens if your win rate is low and your risk reward ratio is high? At the end of the day, you are likely to make more money. But if your risk reward ratio is low, then your whole trading activity may lead to less profitability. This is calculated before a trade decision is made. Before you buy or sell a security, this risk reward ratio is calculated, then a decision is made with this risk reward ratio. Should I make a trade or not? It has nothing to do with the company's valuation. It has nothing to do with the direction of the share price movement. Meaning, if the risk reward ratio is 1:5, that does not mean that price will go up or go down. It has nothing to do with the quality of the business of the company. Please understand the concepts, then try to answer the questions. If you do not understand, ask me in the class. That will help me. It will give me an opportunity to explain you better. But giving answers which are not correct does not help you. Then some students wrote about bullish candlestick patterns, doji and hammer candles. Doji candle indicates indices in the market. It's not a bullish pattern ever. Bullish meaning when the price is likely to go up. Doji has a very small body, higher upper shadow and lower shadow. Hammer candle only indicates that in that time frame, in that candle, bulls had taken the upper hand over the bears. Nothing else. Both the candles indicate a probable trend change. They do not indicate a bullish or bearish trend, either a continuation or reversal. So these are very simple things. I'll encourage you to ask me questions, get clarifications, than when writing anything that comes to your mind with a distorted understanding. That does not help you. Please do pay attention and ask me questions. I hope this clarifies quite a lot of things.